Howdy, who all my stock market gamblers? Welcome today. I'm Tall Mike. So glad you're here. What do we got going on today? Well, it's Memorial Day. Hopefully everybody's out there having a great Memorial Day. But the markets are closed today. I get a little sad when they're closed, but they'll be back open tomorrow. Now, what are they trying to do to the stock market? What are they trying to do? They're trying to push it up to new record highs. I do believe they're going to be able to do that. You see, we haven't had the blow off top yet. The blow off top is what's going to sucker everybody back into the markets, and then there's going to be the big rug pull. But they're going to print the money, and they're going to try to push this up to new record highs, and I do believe they'll be able to do that. You'll be able to get out at the new record high before the rug pull, before the big bear market, which will probably be the biggest bear market of my lifetime starts, because this thing's going to come down, and it's going to come down hard when it does, but not yet. They're going to push it up more, right? They push Bitcoin to a new record high, going to push the stock market to a new record high, going to push Bitcoin even higher, but then the rug pull is going to come. It's going to be what's called a debt devaluation. The debt's just going to be too big, right? $400 trillion worldwide. The United States, 37 trillion in debt, 120 trillion unfunded liabilities. But the bond market's going to come down. And you can watch it in live action on TLT, right? Watch the TLT as it goes lower and lower and lower. What does that mean? It means that rates go higher and higher and higher. This is going to get very, very ugly for real estate as the rates go up, as your mortgage goes past 10, 12, 14%. No buyers for the houses. No buyers now, right? We're in a crisis right now. There's a real estate crisis. Home prices to income ratio have never been higher. They're record high, right? It's a real estate crisis, but it's going to get much worse. It's going to get much worse as we get the debt devaluation, as the bonds come down, as rates go up. We're going to get the job losses. The job losses are going to be piled on top of that from AI, and they're already laying people off. Microsoft just had an announcement laying people off. Google, Meta, everybody's laying people off right now, right? That's going to be really bad, going to create financial hardship for a lot of people. Now, what can they do? Well, they have two options, right? They can go get more debt on their house, because you can't refinance if you're locked in at 2.8%. Why would you refi up here at 7%? So what you have to do is go get a HELOC, a home equity line of credit, and you're going to get that, right, to get more debt, because you're out of work now. You're out of work. Your house is already starting to come down, but you want to stay there, so you go get more debt, right? The other option is to dump it onto the marketplace, which a lot of people will probably take this option, where they just dump the house onto the marketplace and go, hey, I want my equity out before the equity all disappears. And it's going to disappear eventually, right? But they're going to keep printing money, trying to keep this up here, trying to keep it up here. But you see, we don't have a lot of time left. You see, this is a failed experiment, a failed Keynesian economics experiment that they're doing, thinking that we're only going to have straight up markets. We're never going to have a bear market in the stock market. No more bear markets. We can just print money, and if we have to, we'll go buy the stock ourselves. That's what the Fed's thinking, right? They have a trading desk. They can just go in and buy Apple stock. They can go in and buy Google. They can go in and buy Meta. They can buy the stock market themselves, right? They have an unlimited printing press. But you see, the thing is, it's not going to be much longer, because what's happening is our country is getting downgraded by all the credit rating agencies, right? Downgrade after downgrade after downgrade. There's no more AAA for our country. We've always been AAA, but now we're falling off the cliff. It's the end of the empire, right? All empires come to an end. The United States is no different. Look, I love my country. I hope that we stay the top forever, but it doesn't work that way. Why? Because we abused it. We abused the reserve currency. We abused the dollar, right? We've stolen Russia's assets. We've weaponized the dollar, and we continue to print it into oblivion. And the more we print, we're having these things called bond auctions. The bond auctions are failing, right? We had a 20-year auction fail. The Fed had to come in and buy them, right? Why? Because there was no buyers. Nobody wants our debt anymore. Why don't they want to buy our debt anymore? Because they're realizing that it's not safe. They're realizing that gold is returning twice as much as the bond market for the last 30 years. We've returned twice as much in the gold market as the bond market, right? I mean, gold's gone up that much, and the bonds, yeah, they've given you 4%. But if you were in the gold market, you would have got 8 to 10%, so over twice as much. It would have been much safer, right? I mean, if you hold the gold, then the government, they can't steal your money like they stole Russia's assets. You take away that liability. So gold is much safer, much more reliable, and it's returning twice as much. Of course, nobody's there to buy the bonds, so there's not much time left, not much longer, right? So you're going to want to get some real money, get some gold, get some silver if you can't afford gold. Silver, $33 an ounce. I mean, that's the cheapest asset on the planet. But when it breaks, it's going to break really quick. And these things will skyrocket. It'll be like a slingshot going up. And the bonds, they'll be slingshot downward, actually. I mean, they're going to go down, down, down. But you see, here's the thing. As the bond market goes down, no buyers. What happens when there's no buyers? They have to drop. What does the interest rate do? It has to go up, Right now at 5% on the 20-year, no one wants to buy them. Maybe they got to get that up to 10%, maybe 15%, maybe 20%. That's exactly what's going to happen to mortgages. 5, 10, 15, 20%. You see, people think that real estate will go up as we hyperinflate. Not necessarily. The reason is because interest rates go up and real estate is a debt asset. People buy it with debt. 80% of people buy a house with a mortgage, right? And if they can't get a mortgage, I think mortgages, they're not going to be able to get them at any price, but let's say it's at 20% interest rate. What's that going to do to the value of your house? It's going to chop it in half and then probably chop it in half again. It's going to get really ugly for real estate. So real estate is crisis number one, but don't worry, we got a triple threat right now in the United States. Nobody's talking about it. Nobody thinks real estate's in a crisis. How can real estate be in a crisis? Tall Mike, real estate prices aren't record high. There's no crisis. Yes, there is. No buyers. Real estate is in a crisis right now. Most unaffordable it's ever been. Now, what else is in a crisis? Banking system in a crisis because of the real estate market. Real estate's going to get much more uglier. Already ugly on the commercial office buildings. Already ugly on the shopping malls are going into default. Already ugly in the apartment complexes, which are also going into default. There's default. And then, of course, mortgages are becoming very delinquent. 12% on FHA loan delinquency rate. 12%. That's way worse than 2008, but it's the invisible crisis. Why is it invisible? We can't foreclose on them yet, not till the end of this year. Then the foreclosure moratorium goes away and we can go foreclose, and all this will be new inventory coming onto the marketplace. But the banks, they're the bag holder, right? They've lost your money in the bond market, lost your money in commercial real estate, lost your money in shopping center investments, lost your money in apartment investments, losing your money on mortgages, defaults, no one's paying them, credit cards, no one's paying those, auto loans, no one's paying those. And of course, student loans, now 15% of the people aren't paying. Was 1% because, for 5 years you didn't have to pay, right? We had the pandemic. They said you didn't have to pay your student loan debts anymore. So you had a 4 or 5 year moratorium where you didn't have to pay. But now you got to pay, and now the delinquency rate's 15%. So nobody's paying the banks at all, right? Banks are the bag holders. They don't have your money. You get a little run on these banks, and we're going Great Depression style straight up. But you keep your money if you feel safe. You do you. I'm going to do me, right? I don't trust them right now. So that's crisis number 2. No one's talking about it. You don't hear that on mainstream media, that we're in a crisis. We're in a real estate crisis. We're in a banking crisis. No, the third crisis, we're in a retirement crisis, right? Your pensions are so underfunded, but nobody's talking about this. You live in Kentucky, you're funded at 13%. 13%. Like, you're funded at 70 or 80%. You're doing really well. That means you're going to get about 70% of what was promised to you, right? They're going to give you about 70% of your pension. But some pensions are going to go completely belly up. But Mike, the federal government going to come in and they're going to bail my pension out. And you might be right. I'm not saying you're wrong. There's going to be a lot of pension envy, right? Because I don't have a pension. A lot of people don't have pensions. You have a pension. You're expecting to get paid, but your pension made bad investments. They've lost your pension money. They don't have your money. Not that they have Social Security money, which I'm going to get. They're going to print the Social Security money. Maybe they'll print a little extra and give it to your pension. But then you got pension envy because there's going to be a lot of upset people, a lot of social unrest. So we got a triple threat going right now in this country, and that's crisis to crisis to crisis. Real estate crisis, banking crisis, pension crisis. They're all silent. They're all invisible. Nobody's talking about. You listen to Tall Mike, so you hear about them. But what you want to do is get some of that real money, get some of that gold, get some of that silver. Now look at, okay, you go back to the year 1999, right? I think there was a song, Party Like It's 1999, something like that. Anyways, there was a song back in the day. But you go back to that year, right? It took 44 ounces of gold to get one of the Dow, right? 44 ounces to get one of the Dow. What is it right now? Let's just use rough numbers so I can do the math in my head. Let's call it 40,000. Let's call it 3,300. Takes what? About, I don't know, 10, 12 ounces, 13 ounces of gold to get one of the Dow right now. Went from 44 ounces back here in 1999. Now it only takes 13, but you know what? Soon it's going to go 1-to-1 with the Dow. Soon it's going to go 1-to-1 with the Dow. Now I'll start trading some of my gold when it's 2-to-1. I'll start trading for some dividend stocks, right? I mean, they'll be cheap then because the Dow will be coming down or gold will be spiking up so much. But when it gets to 1-to-1, that's where you want to convert it back. See, I don't say you're supposed to hold the gold forever. You're just supposed to hold it throughout this crash, throughout this debt devaluation that we're going through. And we're going through it right now. And I mean, it's sad, you know, but you got the housing market. You got the housing market. People, they got to go get more debt, right? They got to get more debt, but we're going through a debt devaluation. Maybe the banks are going to stop making loans. Maybe they're going to have to sell. Maybe there's going to be that forced selling like back in 2008. That's where the forced selling was. But you know, only about 2% of houses really went into foreclosure. Only about 2%. 2%, think about that. We're 12% delinquent right now on FHA loan. Back in the 2008 crisis, 2%. So it's going to be a lot worse. See, people don't see it coming. It's the invisible crisis. But it is a crisis, and it's starting to be a problem, right? And the problem is coming quicker than you can imagine. Now, us boomers, I mean, we own, I don't know what, 25, 30% of the houses. People over the age of 70 own 30% of the houses. So what are they going to do with them? Well, a lot of them have these McMansions. They want to sell them. They want to downsize. They don't need these big houses anymore, but they can't sell them at these prices, right? They're going to get them cut in half. They're cut in half to where the younger generation will step up and start to buy some of those. But even at half, they're still expensive. So I do think we're going to see this start to come down very quickly. It's going to get very ugly. But the boomers, I mean, we had a great life, right? I mean, since, 1980 on, I mean, all we've done is just print money, print more money, go farther and farther into debt for the next generation. You see, we're not a smart generation. We're smart because we went and partied with it, right? We lived it up. We lived beyond our means. But I mean, the generation that we hand it to, they're going to be very sad because they're going to be in a lot of debt, right? I mean, $150 trillion. They don't mind paying that back for us because that's what we overspent. Okay, well, you see, our politicians, they got us in this big hole, and there's no way out. That's why you have to have the debt devaluation, and it's going to happen. It's going to see it. You're going to see the job market's already rolling over, but they're going to, don't get me wrong, they're going to run that printing press one more time and push it up to record highs, and if you're smart, you're going to get out. Now, maybe we already have topped. I don't know, but I think we're going to push it up one more time, but I wouldn't push my luck much beyond that, right? I mean, eventually the rug pull is going to come. Eventually the debt is going to have to be devalued. It's going to get cut in half. I think bonds are going to get cut in half, right? And then there's a run on the banks and you're not going to get your money. It's going to be really ugly out there, but it's going to be really, really ugly for the real estate market, for the housing market. I know a lot of you don't care. A lot of you locked in at 2.8%. Me, for example, I don't have a mortgage. My house is paid for. I'm not going anywhere. They're going to have to drag me out of here. Day I die, though, man, my heirs will put that on the market. It'll be for sale. It'll be one of the inventory coming on. Anyways, it's Memorial Day, everybody. Get out there, enjoy the day, but first give me the thumbs up. Punch the subscribe button so we can talk more later in the week. Markets are open tomorrow. Very exciting. We'll talk again later in the week. Bye-bye now.